Market are hitting all-time high, but the real question is, are we on the edge of a powerful new bull run or about to face a painful correction? Stick with me, I will break it down in under 7 minutes for you. Welcome to Smart Investing. I am Philippe, CFA charter holder. I have spent 20 years in global market, including executive senior role at Fidelity and Nordea, managing and distributing billions across equities, fixed income, and alternative investment. Today, I cut through the noise to bring you clear insight on where the market really stands and where it's going. First of all, let's start with the big picture. The S&P 500. So let's start with the big picture of the S&P 500. You can see the S&P 500 are pushing into new highs and is powered mainly by tech. So you can see we've broke out the all-time high back in June, and now we are keep pushing higher and higher. The last 4 days we've seen some sideways tradings, but so far there is no sign that the market want to significantly or meaningfully correct from this level. The pace of going higher is actually slowing down a lot, but this is not yet a correction. QQQ the same. QQQ, you can see it's exactly the same. Pushing into new highs, mainly powered by the Max 7. Breaking it back in June, the previous all-time highs when the market was actually speculating this is extremely expensive. The market needs to significantly correct and so on and so on. And after that, then we had a huge correction in April, from February to April. So it's the same thing we're going to see right now. The market is overstretched, the market is overvalued, but so far we don't see any sign of meaningful correction. Now let's move back to IWM, small cap. You can see that small cap is very disappointing. Small cap continue to lag the overall market, showing this rally is not fully based, is not fully broad-based. And you can see it has a high difficulty to go back again to the trading channel. And that's very frustrating. It has a sharp rally from the low of April, but it has a huge difficulty to go back to this trading channel within the 2 yellow lines. And if it does that, then maybe we can go back and retest the all-time high of 244. But you see, all indices broke above the all-time high, except IWM and TLT. Let's go back now to TLT. TLT still trading at the lowest level seen back in 2007. You can see we have to go back to 2007 to see this level of TLT. And although that we have a lot of talk about rate cut, and this is going to fuel the bond market and so on, but it's not sure. So far, the market is not convinced there will be a meaningful rate cut. And if there is a rate cut, the market is not convinced that the rate cut will be impacted on the long end of the bond curve. I remind you that the long end of the bond curve, which is basically what the TLT is not directly impacted by the Fed policy. It's more about broad-based market expectation about inflation and the level of interest rate going forward. And if the market doesn't decrease the long-dated bonds rate significantly, it's because the market still believes inflation will creep up into the economy, and that's why they are demanding higher rate for the long end of the curve. And I believe that if the Fed is cutting rates, this will fuel an increase on the long-dated bonds going forward. Maybe not in the short term. In the short term, maybe there will be a meaningful correction on the long-dated bonds, but in the medium to long term, the long-dated bonds rate will go higher than it is today, because cutting the rate cut on the short hand from the Fed is inflationary. Now, if we look at Max 7, you can see extremely powerful rally from the low of April. Very broke all-time high also in July, end of July, a bit later than the QQQ, but still holding really well above all-time high. Slowing down, you see a small retreat, but are we going to see a meaningful correction from this level? We know that the earnings season has been extremely good for big tech. CapEx is at all-time high historically. They are all invested massively into AI. And the expectation for beating earnings on the next quarters are extremely high, and the earning growth are extremely high as well. So now the question is that are they going to live up to the expectation and then carry the whole market to all-time by the end of the year, or are they going to basically miss this lofty expectation and crash the market by the end of the year? That's basically the main question of where the market is going to go by the end of the year. It's not depending on the rest of the QQQ and SPY. It's mainly depending on the Max 7 direction and strength of earnings in the next following quarters. On the key economic data, last week was mostly about inflation. We had the CPI coming softer than expected, which was a tailwind for risky assets. But after that, we had the PPI, which came up much stronger than expected, which was a bit of a headwind for risky assets. So we had like these two opposite numbers. That was quite destabilizing a bit the probability of rate cut in September, because there is one camp that thinks that CPI is showing no inflation in the economy, and the other camp is saying PPI is coming extremely strong compared to estimates or expectation, and that is a sign the economy is creeping up. Inflation is creeping up in the economy, and these PPI numbers, the strong PPI number, will be reflected in CPI number in the coming months, and that's why Jerome Powell should not cut rate, because it will fuel further inflation expectation and fuel the inflation rate in the market going forward. Obviously, job data remains solid, although that we have seen some weakness on the coming months, on the previous months. The labor market is still holding really, really strong, so there is no worry on that front. Just a bit of weakening, that's it. Trade tension and tariff headline remain nosy, but the main market has started to fade the fear. Of course, last week and this week, all eyes will be on the Fed comments, Jackson Hole, and all this, and all eyes will be to try to scrutinize all the speech about Jerome Powell, interest rate policy and expectation, and whether or not we're going to have a rate cut in September or by the end of the year. So, all in all, challenges at all-time high is at highest level right now. So at this level, three big risks stand out. First of all, valuation are extremely stretched. Earning growth must deliver. Second of all, market concentration is extremely high and mostly focused on Max 7 and big tech. The rally is vulnerable to these Max 7 and big tech companies, and we have rates that remain extremely high, historically speaking. Higher for longer could easily cap further upside to the market. So what next? Here is my roadmap. Short term, we should expect volatility picking up in the market to digest fresh economic data and policy headlines. Medium term, if inflation keeps easing and earning holds its expectation in the next earnings season, new highs are extremely likely, and new highs are sustainable until the end of the year. But the real tells will be small cap and TLT. If they confirm strengths, this rally broadens. If not, we could see a pullback. So to all of you, is this the beginning of a long bull run market, or are we just one headline away from corrections? Let me know your views in the comments, and if you want sharp, fact-based update every week, make sure to subscribe. There is no hype, no fluff, just real market insight. So subscribe, like this video, help me grow this community, and help us all make money into this market. Thanks so much. Bye.